Feel free, Josh, if you'd like to share your screen, you could,
Okay,
put your title page up while we're waiting.
sure. Let me figure out how to do that.
That way I'll have just a nice screen to greet people as they're coming in. And I'll have to let people know that we're doing something a little bit different today. We're hearing about directly about your fund. Isn't that right?
Well, this is actually a case study on a deal we just did.
Oh, okay. Yes. Okay.
Yeah,
Perfect.
which I thought would be interesting.
I must have looked at the wrong presentation yesterday. I think you probably also sent me the presentation on the fund, and I looked at
Oh,
that
really?
and thought that's what we were doing.
Oh no,
That's fine.
no. I thought this would be interesting because if they sent you that, then I apologize. But um, yeah, this I thought would be interesting because this is what's happening in the real world right now,
Yeah.
as we speak.
Yeah. There's a lot of scare stories right now about
Yeah,
the office sector.
yeah.
Ashish, good to see you. All right, we're starting to get people rolling in. A little bit of a slow start.
That's,
Josh, thanks so much for being here.
oh yeah, of course. Yeah, thanks for having me.
Oh, Ashish, were you the one that put me in contact with Josh?
Yes, so I
Yeah.
invested
Excellent.
with Hempel many years ago, and I've been, frankly, Josh, you can close your ears, but delighted, right?
Okay, good.
So I'm looking forward to doing another one with them.
Excellent. All right, welcome everybody. We're starting to have people join. Come on in. I see all the regulars here. Hello, Anita. Hello, Bo, Bob, Dennis, Doug.
Hello.
Eugenio. You still at Intel, Eugenio? You were near my group that got let go.
Yeah, I am still there. Yeah.
Okay. Good. Hello, everybody. Welcome to a wonderful Friday here, and welcome to the Alternative Investing Club. We're going to get going in just a few minutes. Maybe wait till 5 after to let people join. In the meantime, there's a lot going on in the economy right now. It is an interesting and busy time. And so if you have any questions or anything that you want to talk about in this club, as it so happens, actually, our speaker for next week, I was kind of disappointed to say, canceled and moved her talk. She was going to come in and talk to us about inheritance and real estates and trusts. And that was a topic that I was looking forward to hearing about. But she's now going to be on, I think it was October 6th now. So we actually have a free slot next week where we will probably just have a group discussion and go over any concerns or topics that this group wants to talk about. I know we had for a little while been doing a discussion once a month, just so that we're all keeping the club on track, making sure that people are getting the topics that they want to talk about in. So we'll probably be doing that next week unless somebody recommends a really good speaker that wants to come in at that point. Speaking of really good speakers, we do have a really good speaker today. And we're at 34 right now, so we're at about half what we normally have, which is interesting. Glenn, do you think it's because I sent out the invite on Wednesday? I should be sending it out a week or more in advance.
I mean, it could be.
This has been on our calendar for a while.
Yeah, I mean, it's there, right? The generic one is without any kind of details of what the topic is, right? So that one's on, I think, the calendars, through the end of the year.
Okay.
I don't know, like I put in the chat, there's 133 who confirmed.
Okay.
We usually get, south of 50% of it actually in attendance of who confirms. But yeah, usually you should see 50, 60 by now.
Well, before we get to our speaker, let's open it up. Does anybody have any topics that they want to hear about, or just any points they want to bring up before we get started?
Daniel, will you keep growing your beard until the Fed pivots?
I did actually trim it a little yesterday, so it's now in a shape rather than just an explosion. But yeah, I'm enjoying the longer beard hair.
Nice.
Oh, and this part too, yes. And any other topics? All right. Well, then, I think it is a huge honor in here to have Josh. And Josh, I'll let you pronounce your last name for us.
Yeah, sure. Well, as soon as I figure out how to pronounce it, I'll let people know. My entire family all says it differently, but I say Josh Krisnak. It's just a whole bunch of consonants slurred together. You'll see it on the coming page here and how it's spelled.
I had the same problem with my family also. We went to Sweden and they told me I said my name wrong. So
Yeah.
well, Josh is the CEO and founder of Hempel Real Estate. He has quite a bit of real estate under his management and in his portfolio. In addition to that, he owns a series of companies, which I'm sure that in the introduction here, Josh, if you could just give us a quick introduction to yourself, and we'll dive right into the topic of why office is not really dead.
Yeah, great. Well, thanks for having me, everybody. I really appreciate it. Just a quick blurb about me, and then we'll get into the companies that we're talking about today, which is Hempel Real Estate. So I am the CEO of Hempel Real Estate. I'm also the co-founder of 9 other companies that are all involved in the commercial real estate business. We have, I'll just list a few of them, a commercial real estate development company, private equity company. We own 2 banks. We're in the construction business. We're in the parking business. We're in the PACE financing business, and we're in the food hall business. Between our series of companies, we have about 1,500 employees. And I'm not sure exactly how many states we're in now, but I think we're in 14 last time I checked. So that's kind of just a brief history of the different companies that we're involved with. And today, I thought it'd be kind of interesting when I was talking to Daniel. I thought it'd be kind of interesting to talk about what's really going on in the office market. And today, I'm going to show you a case study. This deal is a deal that we recently did. It's not open for investment, so don't reach out for that reason. But it is a case study of something that we recently did in downtown Minneapolis. And I think it's interesting because I think it's kind of a little foreshadowing of what you're going to see across the marketplace over the next 12, maybe 24 months here. So let's just dive right in if that's okay. What we're talking about today is a project called the Sou Plaza. The Sou Plaza is the one shown in gold right here in downtown Minneapolis. And when I first started talking about this project with both my bankers and my investors, I thought I was crazy because he said office, downtown, in Minneapolis, all those are 4-letter words, and nobody could think there would be a good reason to do something like this. And so we're set out to show that there is actually a reason to do something like this. And if I can get my screen to move, there we go. This is just a couple of shots of the property here. You'll see the Sal is actually right in the middle. This is the Timberwolves NBA stadium, and then this right here is the Twin Stadium. So it's right in the middle of downtown. It's a real nice Class A tower. And so a little bit about us first. That's me. Hempel Real Estate was founded in 2001. We're real estate traders, and you'll see this in my track record, but we get in and out of real estate pretty frequently. We're buying and selling something almost every week. Today we just bought a piece of land. But literally it's every week something's moving, and our portfolio is always kind of jumping around size. Between Hempel and our private equity company Midlock, we own just about under $1.5 billion in total real estate. Hempel is based in Minneapolis, and it has an office in Milwaukee, and we really only play in 2 markets, Minneapolis and Milwaukee. And we like to stay kind of close to our knitting on that because we think we have asymmetric information by being in only 2 markets. Some guys and girls, they go out there and they'll own apartment buildings across the entire United States, and they specialize in just apartments, for instance. Some people are more local and specialize in nothing, but really have market knowledge. And that's kind of us. We think we have more market knowledge than the average investor from really anywhere else in the country about Minneapolis. And so we see things and hear things that most people don't. This next page here, this is our track record. So I took over as CEO of the company in about 2010. This is our track record on all projects, every single project that's gone full cycle. So our weighted average realized returns about a 46% annualized. Our realized multiples of 1.92. And then our hold period is a 2.53 multiple, or our 2.53 hold period. So what that means is, as you can see here, is we move in and out of things quickly. We're not going to park your money here for an extended period of time. Now, some deals take longer, some go shorter, but that's what we've averaged over the last 13 years. I will say that a 46% annualized return, it's been, relatively easy to do that over the last, decade, really, because it's been a rising tide. If I could do that for the rest of my life, I'd be the best investor in the world. I don't anticipate to do that forever, but we are entering into a really interesting time. It reminds me a lot of the 2009-10 era, where we made just incredible returns in a short period of time because of the distress. Okay, so let's talk about Sou Plaza. So here's the story with Sou Plaza. It's a Class A building. It was built in 1991. The building is 600,000 square feet, and the current occupancy is 68%. The total parking stalls that we have with this project, which I'll talk about later, is 1,200 parking stalls. That's a really important thing to remember. It's in the middle of downtown. And what's interesting about this project is we're buying this at a 16 cap. That means that if you were to buy this thing today and put no debt on it, it would produce a 16% unlevered return. It's a really, really high cap rate. These things typically would trade in the good times between a 5 to 7 cap. So the cap rates are way wide of where they used to be. We bought the building for $46 million, which is $74 a foot. It appraised at $72 million, which is $117 a foot. And I actually met with the owner who built this in 1991. I met with him on Monday this week. He told me he spent $120 million building it in 1991. So he spent $120 million building it in 1991, and we bought it for $46 million today. The returns, which I'll show you a little bit later here, but the projected returns on the project for our LPs in this deal was a 22% IRR, almost a 3 multiple on the money, which means you triple your money, and the year one cash on cash of about just under 10%. So what's going on? Why does this deal exist? How could you buy a building for a 16% unlevered return right now? And I think I'll move this little thing over here. I'll put that down there. What's happening is it's really, really, really hard to get debt, okay? And this deal was even more challenging because they marketed it as a distressed note sale, not as a fee simple real estate sale. So as hard as it is to get debt on a commercial real estate office building today, it's virtually impossible to get debt on the note acquisition, which basically means like loan on loan financing. They marketed this property when they took it out to market late last year as an $82.5 million distressed note purchase. What we ended up buying was a $46 million fee simple, and I'll tell you how we did that a little bit later. But that was part of the reason why we got such a good deal, because very few people can purchase an $82 million note, let alone an $82 million note on an office building in downtown in Minneapolis. And so there's just a very few people that would actually even look at buying something like that. And so there's few buyers or bidders at that price. All right. Here's a quick history of the deal, how we got to get under contract. The previous owner was a pension fund. It was the Illinois Teachers Pension Fund, and they had bought this building for $155 million in 2011. So $249 a foot. The loan matured in October 2022, and Northwestern Mutual, a big life insurance company, they were actually the lender on this. And so when the loan matured in October 2022, the Illinois Teachers Pension Fund had been trying to refinance it, but they couldn't get anyone to give them any kind of refinance debt. So Northwestern Mutual hired a local broker and said, hey, go try to sell this thing as a distressed note sale. At $82 million, it's going to be well over a 10 cap or be about a 10 cap. So you should be able to sell it at that. Well, one of the biggest mistakes they made is they marketed this around Christmas. And so they put this out to the market. And if you know anything about Minneapolis, no one is coming to Minneapolis in the middle of the winter, certainly not at Christmas time. And when we actually did the buyer interview calls, it was 2 days after Christmas. And so very few people are even in the office around that time to do the buyer interview calls. So there was just a really a low number of bidders that even looked at this thing just simply because of the timing. And ultimately, we were able to negotiate a purchase price of $46 million. What made this thing really special and why we were able to get this thing done was while we had it under contract, we negotiated a deed in lieu with the current owner, the Illinois Teachers Pension Fund. So Northwestern Mutual agreed to sell us the note for 46 million. But then we would still have to go through the foreclosure process. And the foreclosure process takes time and money. And because we were able to negotiate a deed in lieu with the current owner, the Illinois Teachers Pension Fund, we were able to get the property immediately at closing. So we didn't have to foreclose on them. We didn't have to go through the legal process. And more importantly, we can get our hands on the real estate and start operating the real estate much sooner. The biggest risk you have if you foreclose on a building is it could be, between a year and a half before you can actually get in and start operating the building. In that meantime, tenants start leaving, everyone knows it's in foreclosure, and it just is kind of a death spiral. So our ability to get in there and actually negotiate a deed in lieu transaction, which basically means teachers are giving us a deed in lieu of foreclosure, we were able to get control of the asset much sooner. Okay, so here's what I want to talk about, which I think is interesting. And the question is often like, what's happening in office space? Now, if you read the headlines and only read the headlines, you think that it's doom and gloom and the whole world's coming to the end and nobody is ever going to be in an office building ever again. And I'd say that some of that part of that story is true, but a lot of that narrative is false. And so I want to talk about what's happening in our office market in Minneapolis, which I think is very similar to other markets. I know I'm seeing the same thing in Milwaukee. First of all, there's an absolute flight to quality. And what we're seeing is our Class A buildings have never seen higher occupancy and have never seen higher rents. Now, the occupancy on the flight to quality is interesting. The building that I'm actually sitting in right now is our corporate headquarters in suburban Minneapolis. We bought this 3 months before COVID at 60% occupied. Today, we're at 96% occupied. So we went through 3 years during COVID, and we increased the occupancy by 50%. If you have a good quality building, people are willing to move there. But why else is that happening? Well, they're moving there because they want to have good space to retain and recruit talent. And so you'll see people moving to nicer buildings because of that. But the other reason why they're moving there is because their rent isn't necessarily going up, which is number 2, reduction in footprint. Generally across the board, we're seeing kind of a 15-ish% decrease in square footage. Well, if you look at the math here, if you were paying in a lesser building, 10,000 square feet at $18.75 a square foot, your rent would be $187,000 a year. But if you reduce your square footage by 15%, so you go from a 10,000 square foot space to a 8,500 square foot space, you can now afford to pay 20-25% more in rent and still be at the total gross rent of the same amount. So say it another way, you'll take smaller space, you'll pay more per foot, but your total spend is the same. And I think that's an important factor because our Class A stuff is doing extremely well, but the spaces are smaller. The people that are staying in our Class A's are generally downsizing. But the amount of activity we have in the space is really contrary to what you're reading in the papers. The other thing to point out, which is interesting and specific to Minneapolis, is in Minneapolis about 90 days ago, they passed the historic state tax credit. And what this tax credit says is that if you rehabilitate a historic building, anything that's 50 years or older, 40% of your cost comes back to you as a tax credit. Literally a credit that you can either keep for yourselves and use to pay against your income taxes, or you can take that credit and sell it. And there's plenty of corporations that will buy those. And so what that means is with these historic state tax credits coming in, the B and C class buildings are being converted from office space to other uses like residential. And historically that was hard to do because economics just didn't pencil. But when you add the historic state tax credits and the federal credits, federal rehabilitation credits as well, now you can actually afford to convert B and C buildings into something other than office space, which creates a domino effect. When you have buildings that are B and C being converted, That means the office space market is shrinking in that category, in the B and C markets. Well, there's no new buildings really being built right now in most markets, new office buildings, very, very few. And so what's happening is the market of office space is shrinking, which is pushing occupancy into the Class A towers. When you combine that with the need or desire to upgrade, and you combine that with the downsizing of space, the Class A towers are actually starting to see a fair amount of activity. So that's what's I think is kind of really interesting about what's happening out in the marketplace right now, especially in Minnesota. Okay, next slide. All right. So we said, why do we like LaSalle Plaza? Well, the first thing we liked was our low cost basis. The second was we'll have the newest amenities in town, and the third is free parking. Let's dive into each of those. So low cost basis. Now this is really important. The first thing is we have the lowest cost per foot of any Class A tower in Minneapolis. There's not a single person in the market that beats us, and that's not clearly a competitive advantage. If you look here on the chart, the replacement cost to build this building today is almost $400 a foot. Again, we bought it for 74. At a price of almost $400 a foot, that means your rents have to be nearly $40 per square foot net. And we bought it at $7 or $74 a foot, which means we could technically have rents as low as $7 a foot. So it gives you a big competitive advantage. The middle graph here again shows you that we bought it significantly below the last time this project sold about 10 years ago. Equally important with having a low cost basis is the amenities. And so all the other Class A towers in downtown Minneapolis all have a basis of $200 per square foot or lower. But when you have a basis of $200 a square foot $200 a square foot or higher, every other building is $200 a square foot or higher. Well, when you have that kind of basis, it's really hard to reinvest into your property because all you're doing is creating a bigger mountain for you to climb to get your money back out. And so when you come in at a lower basis, a reset basis, it allows you to go in and actually put more money into the building, which we're putting a significant amount of money into the building, and we'll still be able to be below anyone else, but we'll also have the newest amenities. And in the office market, it's kind of like the apartment market. There's kind of an amenities arms race, we call it, where the newest amenities, the best amenitized buildings are the ones that seem to be leasing up the quickest. And so that low cost basis allows us to put all sorts of fun things in. So we'll do state-of-the-art fitness center. We'll do conference rooms and Zoom rooms and podcast rooms. You'll see like in the lower right-hand corner, that's actually a podcast room of where I am today. The building I'm in today. We put golf simulators in. One thing that's been a huge hit is pickleball courts. So on the lower left-hand corner, that's actually one of our Milwaukee office buildings. We put indoor pickleball courts in. Crazy story, I actually landed a 55,000 square foot lease because the CFO of that company loves pickleball and wanted to be able to play pickleball at lunch. So I was like, okay, that sounds great. We put Airbnb suites in. These are like little hotel rooms. They're actually more like little apartments, and we put these in all of our buildings. So if you have a client in town, or if you're working late, or you or your spouse want to go out downtown for the weekend, we have these little hotel suites that people can stay in, and we only charge cleaning service. Rooftop decks. Every building's got a rooftop deck these days. That's what we're putting in, obviously, at LaSalle, and then we have this Escalade service, which I'll talk about here in just a minute. There we go. So one of the things with what we wanted to do with our projects is we wanted to really make it feel like a boutique hotel. And we thought, well, how can we do that? Well, we could add a lot of these amenities. We could change the fit and finish. But one thing that we came up with was we wanted to have this, what we call a black car, white glove service. And so if you're a tenant in LaSalle Plaza, for instance, we have 3 black Escalades that we purchased, and that you can use those Escalades to drive, or they'll be driven around anywhere downtown Minneapolis. And so the North Loop, the green area up there, that's kind of the entertainment district. LaSalle, you see, is about 6, 7, 8 blocks away. So you just order on your app the Escalade, and our concierge will drive you over there and then pick you up. Half our tenants are law firms. If you look on the right-hand part of the screen, that's where the courthouse is. So instead of walking through the Skyway or dragging all your legal files across town, we'll drive you via the Escalade. And so it's just a really hands-on approach that nobody else in town is doing. So that's a little bit about the amenities and what we were offering at LaSalle. Now, we have a saying in our office that we don't like to be the best, we like to be the only. And that's not supposed to sound arrogant. What we're trying to say here is we want to be able to provide something that no one else could provide. And the parking is what became, I think, the linchpin in this whole deal. So in the middle of the screen, you'll see the orange LaSalle Plaza, and you'll see it says 343 stalls. That's how many stalls are in LaSalle Plaza below the building. That's very typical count. Most office buildings don't have many stalls more than around 400 stalls for a Class A tower. Our Class A tower is only 600,000 square feet. Most Class A's are more in $1.2 million to $1.5 million. Even then, they still only have around 400 parking stalls. And what we were hearing as we talked to all sorts of different tenants in downtown, the biggest challenge that people were having was getting their operational staff back downtown. These are employees that are making kind of that $50,000 to $80,000 a year range. And they've been working remotely for 2 to 3 years. And as a result, they weren't having to pay for parking. So now you come in and say, hey, we want everyone back in the office. And oh, by the way, yeah, you have to pay for parking. Well, parking costs you $20 a day. If you take a $20 a day parking and then you got to buy lunch is another $20. Now these staff members are paying $40 a day to come to the office. That became a challenge. Now, if you couple that with student loans potentially coming back, the average student loan is $300 a month, you're starting to have a meaningful impact on how much it costs to have people come back to the office, or just what's happening with their overall monthly economic spend. So we said, okay, what can we do to kind of get around this or get rid of that objection? And this is where the only came in. So you see here on the right-hand part of the screen is a blue box that says LaSalle Court Parking, 848 stalls. What we did is we approached the owner of the parking garage across the street, which is Skyway connected. You see that in the green box. And we said, hey, you've owned this building since 1980. You've moved to Florida. Would there be any chance you'd want to sell this? And just out of pure happenstance, he said, absolutely. I was thinking about selling it next year, but I'm interested in selling it this year if you can make a price that makes sense to me. So after many months of negotiating, while we were just under our due diligence phase of LaSalle Plaza, we got the owner of LaSalle Court, the 848 stall parking garage, to sell to us. He sold it to us for $11,000 a stall. The last parking garage I built was in 2018, and I built that for $36,000 a stall. So we were able to buy the parking garage for about 30 cents on the dollar, and we kind of rolled all that into our economics. And basically what we've created here is free parking for our tenants. There's not a single tower anywhere in downtown Minneapolis that has 1,200 parking stalls, let alone 1,200 stalls with 850 of them being free. We're still going to charge for below the building parking. That's really, really nice space. The 848 is a structured parking garage, but it's across the street. And I think what we're going to do, and we haven't done this officially yet, but I think we're going to market it at 50 cents a day. And the point is not that we care about the 50 cents a day, but we just want to be so ridiculously low that people talk about it. And they'll be like, why? I don't even know why they bother charging us 50 cents. I mean, what difference does it make? Well, that's the whole reason, because we want you to talk about how ridiculous it is. So you tell your friends, and next thing you know, our building's filling up. So that's what created the only for us in LaSalle Plaza. It's almost impossible to replicate because it's not like there's a bunch of structured parking structures, first of all, around town. Most of them have been torn down. And second of all, the chance that the guy had moved to Florida the year before and is looking to sell today, it's pure luck, to be honest with you. And I think what made this deal special. So kind of a little update on what we did on our underwriting. I'll breeze through this pretty quickly here. But what we had said in our underwriting was, put this up here. We said that in our base case assumption, 50% of our tenants were just going to leave. We thought half the world is, working from home. So we said, we're going to underwrite 50% leaving. We then assumed that we're going to reduce the rates on all of our tenants 10 to 30% from where they are today. When tenants renew, we'll pay between 55, I'm sorry, when new tenants move in, we'll pay between 55 to 80 bucks per square foot for a new build out. So again, if you took a, space, we'd give you $1 or $80 per square foot to build your space. We underwrote that we're gonna sell this building as soon as we hit 83% occupied. Historically, we're kind of in that 90 to 92% range. This building historically has been 90% leased. We thought we'd sell this at a 9 cap, so it's an unlevered return of 9%. Historically, this building or these buildings sold between a 5.5 to a 6 cap. We underwrote, free parking, and we thought our hold period on this would be 6 years. I actually think it'll be a lot less than that, but I just didn't want. I can't tell you how fast people are going to start coming back, so we just went to a 6-year hold period. And then our returns on this are obviously stated here below. Our upside case was actually more of our traditional underwriting. And the upside case was renewal probability of 75%. That's what we always, for 20 years, have underwritten that 75% of them would stay. That was our traditional underwriting. So here we said if the upside is 75% stay, our occupancy gets up to 90%, and we sell it as 7 cap, you can see the returns get significantly different. 32% IRR to investors, approaching a 5 multiple on the equity, and an average cash on cash of 12%. So we only changed 3 assumptions. Clearly, those 3 assumptions make a big impact. And that's why it's so incredibly important when you're underwriting a real estate deal to really understand what those assumptions are, because 1 or 2 things can change the return significantly. In any deal that we do, we like to have multiple exit scenarios. Okay, and this case was no different. Of course, our business plan is to lease the building out from 68% to 82%, and then give away some for parking, and then we move on and sell the building. But we said there are 2 other scenarios that we could look at on how to exit this thing. The first way, is to buy the building at 16 cap and turn around and flip it at a 12 cap, and do that in the first 12 months. We assume the capital markets come back a little bit. And if we can do that, we'll make a 50% return on our money in 12 months. And that's only 1.5 multiple, but from an IRR standpoint, it's obviously a very great return. And so we've kept that in the back of our mind. If the capital markets loosen up a little bit, we will absolutely look at an option of selling out of this thing. The other exit scenario, besides completing the business plan, was converting it to apartments. I mean, you've probably seen a lot about this in paper. Again, it's really challenging to do, but we went through the exercise. On the right-hand side here, you'll see how the building lays out for apartments. We actually end up getting about 20 units per floor, depending on the floor you're on. And so it ends up being 432 apartment units. It's a lot of apartments. That math still penciled because of our basis. Realistically, I don't think we'd ever build 432 apartment units. What I think what could happen if we didn't have any success in leasing the space is we would consolidate the office tenants to the upper levels, and the lower levels we would then turn into apartments, where you could end up having 150 apartment units or something like that. That is a realistic scenario if the office space doesn't fully lease. But we, in all of our deals, we like to have 2 or 3 different kind of escape hatches. If you go in there and you think you're just going to have one part of your business plan, as Mike Tyson famously said, everyone has a plan until you get punched in the mouth. And we're ready to get punched in the mouth on all of our deals and try to pivot. And these are kind of our pivot points here for Sou Plaza. All right, so this is just something that I showed our investors. The recap was we had to raise about $30 million in equity from our investors. We put about $4 million in ourselves. Senior debt was about $46 million. Acquisition debt was only $21 million. So future debt was $25, and that was just for future tenant improvements and some capital improvements as well. Our loan to purchase price was only 46% at closing. So we stayed below 50%. We really wanted to keep the debt levels low to give us time to lease up the building without having the pressure of having to make debt payments. And then our loan to appraised value was 30%. Our minimum investment for investors is $25,000. That's always the case for us. distributions. We always like to start our distributions about 90 days after we own the building because we like to get our sea legs underneath us and kind of see how the property performs. And so this just closed. You can see here, this closed on June 23rd. So where we are today. So we acquired it on June 26th, was the actual closing date. We just acquired the parking garage last Friday, so just a week ago, July 28th. Two separate closings, two separate buyers. And it's been a really interesting time. We've spent the last 30 days meeting with all of our tenants, and the feedback has been incredible. The tenants love the free parking. That's like the biggest and best thing. We had one tenant that was going to vacate, and they're saying, "Hey, listen, this free parking is a game changer for us. Oh, and by the way, we're going to increase our square footage by 10,000 feet." So this free parking went from a tenant absolutely moving out to a tenant actually expanding. They also love the fact that we're reinvesting in the building, and that we're local ownership. What you see out there, especially a lot of these institutional owners, they become zombie owners. They can't reinvest in the building. So as a result, they don't engage with their tenants. And then now there's nobody for the tenants even to talk to. So for us to come in and say, hey, we're local, we own, we live, all of it's in town. We've had really, really great feedback. But nothing has been greater than the free parking. So that's the story. That's the building. I think at this point, Dan, you'll have to tell me, but I'd be more than willing to answer any questions people have about the marketplace.
Absolutely. Let's open it up to questions. And we do have a couple of them that were put in initially towards the beginning of the presentation.
Sure.
Let's see here. So there was a question from Glenn about the shrinking of the square footage. And his question is, are they shrinking the square footage because of higher per square foot prices, or is the square foot price, are they going down because of the shrinking footprints? So are you I guess what is the cause and effect of being able to produce the same input but shrink the
so here's what I'm seeing. Tenants are wanting fewer private offices, more cube style, but not everyone's in the office at the exact same time. People are in the office kind of Tuesday, Wednesday are the busiest days. Tuesday, Wednesday, Thursday, you can make the argument. Mondays and Fridays are very quiet. But when everyone's in the office, they actually want more conference room space. And so what you'll see is during the middle of the week, people will be having their meetings. And so that's why it's really important for these office buildings to have a lot of free conference space. And as a result of that, not everyone's sitting at their desk all day. So they need less square footage for offices.
Okay, let's see here. Ashish, can you give us a glimpse into Hempel's upcoming deals? Every speaker loves that question, right?
Yeah. For the first time in a long time, I don't have anything under contract right now. It is a really interesting market. The bid-ask spread between the buyers and sellers is very significant, although it's quickly squeezing down because sellers are realizing if they don't sell now, that price could be even lower 30 days from now. I mean, just look at the 10-year. The 10-year, I was looking at this morning, in the last 14 days, the 10-year treasury has gone up almost, well, I haven't checked it since this morning, but it's kind of almost 50 basis points in the last 14 days. I mean, it's been crazy. And so I think buyers and sellers are starting to get closer together. What we're doing, I'll just tell you what we're doing as an organization right now. What we're doing is we're solely looking at, I shouldn't say solely, but primarily looking at either distressed debt, distressed sales, or something that is, again, not the best, but the only, an asset that's irreplaceable. Something that you really would love to own long-term. From a distressed debt standpoint, what we're doing right now is there are about 250 banks in Minnesota. We are actually sitting down with every bank that's under $5 billion in asset value in Minnesota. And the reason is twofold. The first is between our companies, we have about $100 million in deposits. Every bank is starving for deposits right now. So we're going around to the various banks and saying, listen, we've got $100 million to put into a whole bunch of banks, and we want to have a symbiotic relationship. So we'll put $3 million in your bank as a deposit, but we want to talk to you for one of three reasons. Either A, if you've got borrowers that are in distress, we've got capital to invest into helping your borrowers get out of their issue. We'll come up with mezzanine financing or preferred equity or something like that. And two, if you've got loans that you know are just no good, you know that your borrower just can't work their way out of them, you want to get them off your balance sheet and free up some liquidity, we can buy that loan from you. And then three, Mr. Banker, if you are looking for an injection of capital into your bank, or maybe even looking to sell your bank, we'd be interested in looking at buying your bank as well. So that's why we're meeting with these different banks. And so I think the vast majority of the stuff that we're going to be looking at over the next, I don't know, 12 to 24 months will be almost exclusively, from Hempel's standpoint, distress.
That's fascinating to hear distressed debt right now. I've heard a number of people moving in the direction of offering that, and there are a lot of debt funds being created right now. So it's interesting you mentioned that.
Yeah, well, we made a lot of money during that last recession buying just busted and broken deals, and you make a lot of money fast, especially if the rates come back down. And that I don't know, but especially then.
Okay. Let's check the questions again. Let's see. Do you pass depreciation on to your investors?
Absolutely. Yep. Yeah, we do a cost segregation across every single deal that we do. And then we will pass that directly on to the investors based on their ownership percentage.
Mario is asking, what factors go into the variability of rental rate reductions from 10 to 30%? And Mario, I'm not sure if you followed that question completely. I would need some clarification, but
I know what he's saying. Yeah.
Okay.
So we had said that we're going to reduce the rent for each tenant somewhere between 10 to 30%. That was just in our underwriting. And it kind of came into kind of two different factors. The first factor is there is no actual free lunch. And so free parking does cost something, right? Because you got to maintain the ramp and all that stuff. And so if you didn't take any parking and your rent was at market rate. So your rent wasn't a deal that someone did a super great economic deal, but it's just a market rate rent, and you didn't want any parking, we actually underwrote reducing your rent by 30%. That was our underwriting. However, if you took the free parking and your rent was at market rate, we would reduce your rent to only around 10%. And so that was what created the variability. And we kind of choose your own adventure on how you want to handle that.
All right. Exit time for the deals, that at least this deal that you mentioned here was 6 years, I know.
Yep.
Is that's pretty typical of, I guess you don't have more deals in the pipeline, you said.
Yeah. I guess our typical deal, if I go back to this page, our typical weighted average hold period is 2.53 years. So generally speaking, we're in and out of our deals. I always underwrite to at least a 5-year hold. I always do, just because you cannot play the market cycles and expect that you can always get out within 2 to 3 years. And so I never underwrite that. And I caution investors, if someone's showing you a high IRR, but they're getting out in 24 to 36 months, you really need to look at that project on at least a 5-year hold, because if you can make any IRR looks great if you get in and out quick, but if you have to hold that thing a lot longer, those IRRs can get smoked. And so, or not always, but they can. And so any deal that we do, we always underwrite to a 5-year hold, or in this case, a 6-year hold. And then we just try to get the money back a heck of a lot sooner than that.
Travis is asking, how many total tenants are there in a building like this? And what are the lengths of their loans or the leases?
Oh, okay. So I don't know the exact number. I should probably know that off the top of my head, but I don't. But yeah, my guess would tell you it's somewhere in that kind of somewhere just, well, let me just do some math here. It's probably around 45 tenants, something like that. Let's do some quick math. And divided by 15. Yeah, it's right around there, about 45 tenants. The lease lengths are all over the place. The one thing about this project that is important to know, and what you should always ask, is what's the WALT? What's the weighted average lease term? And that basically means if one big tenant obviously has a disproportionate share of the building, the weighted average lease term will be much shorter. The biggest risk that we saw going into this building up front is we have one tenant that takes about 20% of the total building. They're a law firm. They're the highest grossing law firm in town, litigators. They've been there since 1991. And so their lease is coming up for renewal in just under 5 years. And so we thought it was really important to get out in front of them. We met with them a day or a week after we closed. We met with them before we closed, of course, and we met with them a week after we closed. And that's going to be the most important key to this one, is getting those guys to renew, because they take about 20% of the total occupancy. Now we got 5 years to get there, so it's not like, it's a burning bridge right now, but you certainly don't want to disregard them at all because of their occupancy percentage.
All right. Ashish is asking, do you have any plans to start a distressed debt fund?
We do. We absolutely do. We're starting to see these opportunities. You got 3 distressed debt deals I'm working on right now. None of them are available for offering yet. Just because we don't have anything doesn't mean that we're not working on stuff. One's a big one. One's a $92 million distressed deal. There's a couple smaller ones here in Minneapolis, kind of that $10 million range. But yeah, we're looking very seriously at putting together a distressed debt fund. And this would be, by the way, this would be our 4th fund. We've done funds before as well. So.
Okay. And Eugenio is asking, is Hempel's bank a retail bank, a private bank? Can Josh explain how they use a bank in their operations?
Sure. So we're involved with 3 different banks here in town. One I'm just a small investor in. The other 2 I sit on the board of, and one of the principals that controls the bank. And so the first thing, is it a private bank or a commercial bank or a retail bank? We are just a local community bank, just like any other community bank in the country. We're open to any and all types of customers, of course. From our standpoint, we like using them. In fact, we used all 3 of my banks on this deal to help finance the acquisition. But that's how we use them in our operations. We also use the banks to talk with other banks. As a developer, if I come in here and say, "Hey, I'm a developer, I want to buy all your debt," they're going to view me as a vulture and think I'm going to try to scrape the best possible price. If I come in as a bank and say, "Hey, listen, we're here to help your clients. There's things that we can do, whether it's buy your distressed debt or give them some loan or some participation equity or something like that." They view us more as a helpful party versus a vulture. We're also always willing to help these banks, help them work out of troubled deals, so they can hire us to come in there, fix up a problem for them, and then obviously turn around and pay that loan off long term. A good loan is a repaid loan. That's what we always say. So banks are always trying to find ways to get repaid as best as possible.
Ashish is asking, how has the disruption affected current Hempel-owned office buildings?
Yeah, my occupancy, my rents have never been higher. Never, ever been higher. It's fantastic. Just signed another 10,000 square foot lease today, this morning. I mean, we're getting fantastic activity. Just in the last 3 months, I've signed over 100,000 square feet of leases. And so it's really incredible. What is hurting right now is the debt market. And so the building that, for instance, that I'm sitting in right now is a building that we own. I told you we bought it 60% occupied, brought up to 96% occupied. Building's cash flowing almost. We just signed a couple leases, so when this thing starts, when the new tenants move in, this is going to be cash flowing, cash on cash, 20% annualized. Okay, so it's a great piece of real estate. The pricing I'm getting on it right now, because I took it out the market to sell it, because our business plan is sell it in 4 years, and we're about 3.5 years into that business plan. The pricing right now is, between 11 to 12 caps. And that is strictly due to interest rates. People like to have a spread between the interest rate and the cap rate. You got to have positive leverage on the purchase, and office debt is probably the most expensive debt out there right now. And as a result, you're going to be between 2, 3, maybe even 400 basis points above what the office debt rate is. Now, the nice thing about multifamily, which has always been a plus to multifamily versus office, is you have Fannie and Freddie as lenders. Fannie and Freddie will always be around. Well, I think they will, at least we hope they will. And they will always have the ability to give very, very competitive debt terms, especially compared to community banks, and certainly compared to debt funds. And so until the capital markets settle down a little bit, it's just going to be a hard time to sell office buildings for at least, I'm sure, the rest of this year and probably into next year. So that's our buildings. Performance-wise are great. Exiting-wise is going to be a little bit tough in the immediate future.
Eugenio has an interesting question here.
Yeah.
Can Josh explain how they developed asymmetric expert knowledge in a market that turns into a competitive advantage?
Sure. So the way we look at this is, I know pretty much all the brokers in town. Between myself and my team, we know most of the bankers in town, certainly most of the bank owners. And so we just have our ear to the ground a lot closer. We know a lot of the business owners are my neighbors, or they're at my country club or whatever. So I just hear more, and my team hears more about what's happening in the marketplace compared to, say, you, Daniel, who maybe you're a wonderful real estate investor, but you don't live here. And so there's no way you can be competitive with that unless you have a partner that lives here. And so we use that information, and we'll find out where our tenant's moving before the rest of the world knows. We'll know who's running into financial problems typically before the rest of the world knows. A lot of times our banks are participants with other banks on loans. And so we'll hear about a deal that's struggling because they have to come in and ask for a renegotiation on loan terms. And so I'll hear that from the bank side, and I'll know that in the marketplace. And so it just, the knowledge is power, I guess. And because we're local, we just have more knowledge.
All right. We're out of questions in the chat, so I'll open it up to audio questions. If you want to take yourself off mute, we've got 8 minutes left. Ashish?
Yeah. I was going to share with the group that I invested with Josh 3 years ago, I believe. And personally, I've been delighted with everything, right? The communication's great. The distributions are on time. So Josh, I definitely plan on attending on participating in your next offering, right? I missed Sou Plaza.
Yeah.
So thanks for coming in.
Yeah, thank you. Well, what I like to tell our investors is twofold. First of all, if you ever come in small. Start off small. If you like what we do, there's always another opportunity. And to that same extent, deals are like buses. So if you miss one, like the Sou Plaza here, there's going to be another one right behind it. I promise you. There should be no fear of missing out. There's going to be plenty of opportunity here in the upcoming months.
Jeff is asking, how small is small?
25,000 is our minimum. So come in for 25,000, and my biggest investor came in for 25, and now they're somewhere in the 8 figures.
I think that answers Marco's question too.
Yeah.
All right. Well, everybody, hey, can you guys take yourselves off mute and thank Josh for coming in here and speaking to us today?
Thank you, Josh.
Thank you, Josh.
Thank you.
Thanks, Josh.
Josh.
Appreciate the presentation.
Thank you, Josh.
Thank you, Josh.
Thanks, Josh.
Thank you very much. My pleasure.
Good job.
And I'd like to be a resource to you guys, not for my own selfish reasons, but if you ever have questions about anything in real estate, I get questions from my investors. We have about 2,000 investors. And so we get questions all the time. I have a whole investor relations team. So if it's for any question you have in anything, feel free to drop me a line. Here's my contact information, and we'll be sure to get back to you.
Before you sign off, Glenn had an interesting question that he just popped in. Are you typically doing individual deals, or do you tend to operate through funds? And what's your perspective on the difference?
Okay, so both. We started off doing syndications about 23 years ago, and we've been doing that ever since. So we always do have syndications each year. We also have a series of funds. Those are funds that kind of focus more on industrial and apartments. I'd say it's a little less risky. The nice thing about a fund is there's no selection bias, right? You don't cherry pick which one you think is the best deal. And by the nature of a fund, and like a mutual fund, you should be able to get a little bit less risk, a little bit more consistent return. I'd like to say that our returns are always consistent, but I will tell you that I've lost money on 3 deals in 23 years. All of them were before 2008 or as a result of 2008. And all of them were because either a tenant went bankrupt or we had a lender maturity type default issue. That's why we're also very careful on how much leverage we put in. But takeaway is syndications are always available. We do have a series of funds. I'd be happy to talk to people about that. And then in our funds, we do allow people to double down on those assets that the fund is buying. So for instance, if we're buying an apartment building through our fund and you really like that part of the country or that building in particular, you can come in what's called a sidecar and invest that way as well.
All right. And last question here. Any recommendations on how the small-time non-syndicating investor can prepare for what's coming?
So I guess I have to know more about what that
What's
means. Well, what's a small-time non-syndicating investor? I guess does that mean someone that's going into funds? I guess I don't know.
Yeah, I suppose the person who's putting individual capital contributions into deals.
Sure.
Or maybe
Yeah.
Non-accredited. We've got to mix of those in
Non-accredited,
too.
Brown.
Sure. Non-accredited, I'll tell you one thing. I have very little, like 0.5% of my net worth in the stock market. So when it comes to giving any advice there, I have no idea. If you are looking at real estate, which is really the only thing I specialize in, the biggest and most important thing you can do out there is watch your leverage and get long dated debt. So we went out about a year ago and locked down on over 100 loans, refinanced everything that had relatively short term, basically 3 years or less in term, and we refinanced everything. And we were be sure and careful not to push that debt up. And because the simple math is, listen, if you're at 80% leverage and then the market drops by 20%, well, now you're at 100% leverage and your equity's gone. And then you're forced to sell or put more equity in. And if you don't have any more equity, then you're just forced to sell, and you're forced to sell at the most inopportune time. So we learned that the hard way in 2008. We were much younger and had less capital. So the most important thing I can tell anyone is just watch your leverage and then try to fix your debt for as far as you can out in the future.
All right, Josh, thank you so much for coming in and talking to the Alternative Investing Club.
Yeah, thanks for having me, everybody. And like I said, reach out anytime. I really appreciate it.
Thanks,
All
Josh.
right.
This is
Yep.
awesome.
Yep. Okay. Take care.
Next week, we're going to have a club discussion. Unless somebody sends me somebody interesting to fill the spot that was vacated. So club discussion. So bring your thoughts, bring your questions. We'll talk about anything that you throw out there. See y'all later.
Thanks. Have a good
Thank-
weekend.
Thank you,
Thank you.
Josh.
Thank
Yeah,
you.
bye.
Take care. Bye.